You need to hear this if you're a trader or investor looking to master the stock market. The stock market can seem like a complex and unpredictable beast, with its constant ups and downs. Prices fluctuate constantly, driven by a multitude of factors, including economic indicators, company performance, and global events. For aspiring traders and investors, making sense of this chaotic environment is crucial for success. Understanding the market's behavior can be the difference between profit and loss. This is where technical analysis comes in. It provides a structured approach to understanding market movements. Imagine having a set of tools that can help you decipher market trends and anticipate future price movements. These tools can be invaluable in making informed decisions. That's the power of technical analysis. It empowers you to make sense of the seemingly random price changes. By understanding its principles, you gain a significant edge in navigating the complexities of the stock market. You can identify trends, patterns, and key signals. Technical analysis is not about predicting the future with absolute certainty. It's about understanding probabilities and making informed trading decisions. It helps you manage risks and seize opportunities. By recognizing patterns and signals in historical price data, you can identify potential trading opportunities and manage risks effectively. This historical perspective is crucial for making educated guesses about future movements. This essay will guide you through the fundamentals of technical analysis, equipping you with the knowledge to approach the market with greater confidence. Whether you're a novice or an experienced trader, understanding these concepts can enhance your trading strategy and improve your market insights. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. This approach is widely used by traders and investors to make informed decisions about buying and selling stocks, commodities, and other financial instruments. Technical analysts believe that all known fundamental factors that could affect a security's price are already factored into the price. They argue that the market price reflects all available information, including news, earnings reports, and economic data. Instead of focusing on a company's financial statements or economic indicators, technical analysis examines the historical price and volume data of a security to identify patterns and trends. These patterns can include support and resistance levels, moving averages, and various chart formations like head and shoulders or double bottoms. This approach is based on the premise that price reflects all. In other words, the price of a security at any given time is a true representation of its value, considering all influencing factors. Essentially, everything that can influence a security's price, news, economic data, investor sentiment, is ultimately reflected in its price movements. By analyzing these movements, technical analysts aim to predict future price direction. By studying these movements, technical analysts aim to anticipate future price direction and capitalize on trading opportunities. They use various tools and techniques, such as trend lines, chart patterns, and technical indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD. While fundamental analysis focuses on the intrinsic value of a security, technical analysis is solely concerned with price action and its implications. This makes it a valuable tool for short-term traders who are looking to take advantage of market fluctuations and price movements. Technical analysis is the concept of price trends. A trend simply refers to the general direction in which a security's price is moving. Trends can be upward, bullish, downward, bearish, or sideways, ranging. Identifying the prevailing trend is crucial for technical traders, as it provides valuable insights into the underlying momentum of a security. Uptrends are characterized by a series of higher highs and higher lows, indicating buying pressure. Downtrends, on the other hand, exhibit lower highs and lower lows, reflecting selling pressure. Sideways trends, also known as consolidations or ranges, occur when prices fluctuate within a defined horizontal channel, suggesting a balance between buyers and sellers. Understanding the direction and strength of a trend helps traders make informed decisions about when to enter or exit positions. In technical analysis, support and resistance levels are crucial concepts that help traders identify potential price reversal points. Support acts as a floor below which the price of a security is unlikely to fall, while resistance acts as a ceiling, above which the price is unlikely to rise. Support is formed when there is a significant demand for a security at a particular price level, preventing it from falling further. Conversely, resistance arises when there is a substantial supply of the security at a certain price, hindering its upward movement. These levels are not always precise points but rather zones where price action tends to consolidate or reverse. Recognizing and understanding support and resistance levels is essential for setting entry and exit points, as well as placing stop-loss orders to manage risk. Volume, the fuel of market moves. While price action is the primary focus of technical analysis, volume plays a crucial supporting role. Volume refers to the number of shares or contracts traded in a security over a given period. It provides valuable insights into the strength and conviction behind price movements. Generally, rising prices accompanied by increasing volume indicate strong buying interest and a healthy uptrend. Conversely, falling prices on high volume suggest strong selling pressure and a bearish downtrend. Low volume, on the other hand, can signal a lack of conviction or interest in the market, often leading to choppy and unreliable price movements. Traders use volume as a confirmation tool to validate price breakouts, identify potential trend reversals, and gauge the overall strength of a move. Essential technical indicators, moving averages, RSI, and MACD. These indicators are crucial tools for traders and investors alike. Technical indicators are mathematical calculations based on a security's price and volume data. They are designed to help traders interpret market behavior and predict future price movements. They provide traders with additional insights into trend direction, momentum, and potential overbought or oversold conditions. This information can be invaluable when making trading decisions. While there are numerous technical indicators available, some of the most widely used include moving averages, which are essential for identifying the direction of the trend and smoothing out price data, the relative strength index, or RSI, which helps traders determine if a stock is overbought or oversold by measuring the speed and change of price movements, and the moving average convergence divergence, or MACD, which is used to identify changes in the strength, direction, momentum, and duration of a trend. Moving averages help smooth out price fluctuations and identify the underlying trend. They are calculated by averaging a security's price over a specific number of periods. The RSI is a momentum oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions. It ranges from 0 to 100 with levels above 70 indicating overbought conditions and levels below 30 indicating oversold conditions. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of prices. It consists of the MACD line, the signal line, and the histogram, which helps traders identify potential buy and sell signals. By understanding the signals generated by these indicators, traders can make more informed decisions about entry and exit points. This can significantly enhance their trading strategies and improve their chances of success in the market. Recognizing chart patterns, head and shoulders, double tops, bottoms, and triangles. Chart patterns are distinctive formations that appear on price charts, representing predictable market behavior. These patterns provide valuable insights into potential trend reversals and continuations. Some of the most common chart patterns include head and shoulders, double tops, bottoms, and triangles. The head and shoulders pattern, resembling its namesake, signals a potential trend reversal from bullish to bearish. A double top, formed by two consecutive peaks at roughly the same price level, suggests a potential reversal from an uptrend to a downtrend. Conversely, a double bottom, characterized by two consecutive troughs at similar price levels, indicates a potential reversal from a downtrend to an uptrend. Triangles, formed by converging trend lines, represent periods of consolidation and can precede either a breakout or a breakdown. Practical tips for applying technical analysis. While understanding the theoretical concepts of technical analysis is important, successfully applying them in real-world trading requires practice, discipline, and a sound trading plan. First and foremost, combine different technical indicators and chart patterns to confirm trading signals. Never rely on a single indicator in isolation. Stay informed about market news and events that could impact your trades, as technical analysis should always be used in conjunction with a solid understanding of market fundamentals. Finally, practice prudent risk management by setting stop-loss orders to limit potential losses and always trading with capital you can afford to lose. Conclusion: your journey to technical mastery. Technical analysis is a powerful tool that can significantly enhance your trading decisions. By understanding price trends, support and resistance levels, volume analysis, technical indicators, and chart patterns, you gain a valuable edge in navigating the complexities of the stock market. Remember that technical analysis is not an exact science but rather a skill that requires continuous learning, practice, and adaptation. As you delve deeper into the world of technical analysis, embrace the journey of discovery and refinement. With dedication and perseverance, you can master these tools and unlock your potential for success in the exciting world of stock market trading. Let me know in the comments below, and if you found this video helpful, don't forget to hit that like button and subscribe for more financial tips and stock market insights. See you in the next video.